My name is Harris Ligon. The question's really around some of these kind of headline metrics, right? Velocity, dwell time, train speed. All that I read into that is that the infrastructure is ready. The economy just simply needs to come back and leverage the network that's ready to go. And so the way that I read into it is that things are moving very well for the amount of volume that's out there today. If we were to see a spike of 20, 25, 30%, I think there are some questions around, do we have enough resources around the table? And are the interchanges and everything that bring these 600 railroads together, are they ready to function at a much higher level? That's yet to be seen, but boy, that would be a really good story to have to go out and test that. And I think there are some scenes that are beginning to show up that we actually may be coming back a little bit, at least on the freight demand standpoint. And if that's true and that actually plays out, really excited for that news to come to fruition. Where are the areas and the pockets of demand that have started to pick up? And so one of the things we've definitely noticed is flatbed demand and over-the-road trucking demand has started to tick up in a handful of markets. Some of that is related to manufacturing, some of that is related to consumer restocking, and those are all good signs. Whether those are sustainable, still some questions to be out there. Where we expect to see that begin to roll over is if trucking capacity does sustain a tightness and prices begin to rise there, we would expect that people would pivot over to intermodal, especially if service remains at the level that it is, because right now there's a massive gap between intermodal spot prices and where we would expect them to be, assuming that, demand is going to come back. So right now it's actually one of probably the most advantageous times to buy into intermodal and secure some of those rates before the likely uptick that's going to come from either increased demand or increased fuel costs. When I really think about it, it is the majority of the railroads in different ways and different language and different vernacular are all saying they're open and ready for business. Some of them are saying that, and I think others are actually actively pursuing short line partnerships or new service offerings where they have established options for shippers that they're hoping to kind of source some demand for. What we're not hearing is that folks are across the board looking to actually create price incentives for people to bring more volume over to the railroad. I'm not saying anybody's going to discuss that in an earnings call because it is absolutely the wrong environment, but it feels like to me that there are opportunities out there to be a little more aggressive. And I've heard from shippers that there are some railroads that are actually actively hunting business and participating in live real-time negotiations, which has candidly been really fun to hear about because it feels like there is a little bit of hunger to fill the network again, which is really great. I think on the other side of the operational kind of perspective, shippers should feel really engaged that if they have an opportunity to speak up about where they have service challenges or where they need additional service, now's the time to talk about that because, for the most part, they're setting their plan for the year and they're thinking about new train starts that could potentially come up in late Q2, late Q3, or late Q4. And if there were to be a new combination of train services or OD pairs that they could surface, I think that now is the time to go have those conversations.